Bernie Madoff ran the largest Ponzi scheme in history for nearly 50 years. 50 years. Through multiple market crashes, regulatory investigations, and economic crises. His clients included major banks, hedge funds, celebrities, and thousands of ordinary investors. He stole $65 billion. He was eventually caught not by regulators, not by auditors, not by sophisticated financial analysis. He was caught because the 2008 financial crisis caused too many clients to request withdrawals simultaneously, and he ran out of money to pay them. The SEC had received multiple detailed complaints about Madoff going back to 1999. A financial analyst named Harry Markopolos submitted a 21-page report explaining mathematically that Madoff's returns were impossible. The SEC investigated and found nothing. For nearly a decade, someone handed regulators the proof on a silver platter, and it didn't matter. Today I'm going to show you exactly how Ponzi schemes work, why they're so hard to detect, and most importantly, the specific warning signs that appear in every single one without exception. Let's start with the basic mechanics. A Ponzi scheme is not a complicated fraud. The concept is simple. You promise investors high returns. Investors give you money. You use new investor money to pay returns to existing investors. You keep a portion for yourself. You tell existing investors their returns are the result of brilliant investing. They're actually being paid with other people's deposits. The scheme works as long as new money coming in exceeds withdrawals going out. As long as you can attract new investors faster than existing investors want to take their money out, the scheme appears to be functioning perfectly. But it requires constant growth. The pool of potential new investors is finite, and every promised return that gets paid out increases the total obligation. The scheme must eventually collapse. This is mathematical certainty. There is no version of a Ponzi scheme that doesn't eventually fail. The only question is when. Charles Ponzi ran his version in 1920. He promised investors 50% returns in 45 days by exploiting price differences in international postal reply coupons. He attracted millions of dollars from tens of thousands of investors. He paid early investors with later investor money. Within 8 months, the scheme collapsed. He went to prison. He didn't invent the scheme, but it was named after him because of how publicly and dramatically it failed. Madoff's version was more sophisticated in one key way. He didn't promise spectacular returns. He promised consistent, moderate returns, around 10 to 12% per year, steady, every year, regardless of market conditions. This is actually more suspicious than promising huge returns if you know what to look for. No legitimate investment strategy generates perfectly consistent 10 to 12% returns year after year, regardless of whether markets are up or down. The consistency itself was the red flag. But consistency feels safe. It feels reliable. It doesn't trigger the same skepticism that 50% return promises trigger. Now let's talk about why smart people fall for these schemes. Because Madoff's victims included people who ran major financial institutions, people who spent their careers in finance, people who should have known better. The first reason is social proof and exclusivity. Madoff didn't advertise. You couldn't just call his firm and open an account. Access was controlled. You had to be introduced by an existing client. You had to be part of the right social circles, Jewish community organizations, country clubs, exclusive networks. This exclusivity created a powerful psychological effect. Being accepted as a Madoff client felt like being admitted to a club. It felt like insider access to something special, the social proof of other respected investors being in the fund reduced skepticism. If everyone you trust is in this investment, surely it must be legitimate. This is a deliberate manipulation of social trust. And it works precisely because smart people trust other smart people. The fraud spreads through networks of trust. The second reason is the confirmation bias trap. Once someone is invested and receiving the promised returns, every statement they receive confirms that the investment is working. The returns are there on paper. The statements look professional. The firm has a real office and real employees. People don't look for evidence that something is wrong when everything appears to be right. They look for confirmation of what they already believe. And the scheme provides confirmation at every step until it doesn't. The third reason is the sunk cost effect. Once you've been invested for a year and received returns and told your friends and family about this amazing investment, admitting you might have made a mistake requires acknowledging all of that was wrong. The social cost of being the person who fell for a fraud is enormous. So people rationalize. They dismiss concerns. They find reasons why the skeptical analysis is wrong. They stay invested longer than their instincts might suggest they should, because leaving would mean confronting something uncomfortable. The fourth reason is complexity as a shield. Madoff told clients he was using a complex option strategy called split strike conversion. This strategy was real. It exists, but it couldn't possibly generate the returns he was claiming. Most clients didn't understand the strategy well enough to evaluate this claim, and they trusted that someone as successful and prominent as Madoff wouldn't lie to them about something so fundamental. Fraudsters rely on complexity to prevent scrutiny. If investors can't understand the strategy, they can't verify that it's working. They have to trust, and trust is exploitable. Now let's go through the warning signs that appear in every Ponzi scheme without exception. Warning sign 1. Returns that are too consistent. Real investments are volatile. Stock portfolios go up and down with market conditions. Real estate values fluctuate. Even the best hedge funds have bad years. Any investment that reports consistent positive returns regardless of market conditions should be treated with extreme skepticism. Consistency that defies market conditions is not the sign of exceptional skill. It is the sign that the returns are fabricated. When markets crashed in 2008, almost every legitimate investment lost significant value. Madoff's fund reported small gains. That alone should have been disqualifying. Warning sign 2. Unverifiable or vague strategy. If you cannot understand how an investment makes money, you cannot evaluate whether it's legitimate. This doesn't mean you need to understand every technical detail. It means you should be able to understand the basic mechanism. We buy undervalued companies and wait for them to appreciate. We lend money to real estate developers and charge interest. We trade currency exchange rate differences between markets. These are understandable. If someone says we use a proprietary algorithmic strategy that's too complex to explain, but trust us, it works, that's a red flag. Warning sign 3. Pressure to reinvest rather than withdraw. Ponzi schemes need money to stay in the pool. When investors want to withdraw, it drains the available funds. Legitimate investments allow withdrawals without pressure. Ponzi schemes often make withdrawal difficult, slow, or subtly discouraged. If you feel pressure to keep your money invested, or if withdrawal requests are met with delays and complicated explanations, be very concerned. Warning sign 4. Unregistered investments or unregistered advisors. In the United States, investment advisors managing significant assets must register with the SEC or state regulators. Investment products must be registered unless they qualify for specific exemptions. These registrations create oversight and accountability. Many Ponzi schemes operate in the gaps, exempt from registration requirements through claimed exemptions, or using registration to create an appearance of legitimacy while still committing fraud. But checking registration is a basic first step. Go to the SEC's website, look up the advisor, look up the fund. Verify that what you're told matches what's on record. Warning sign 5. Exclusive access and social network distribution. Legitimate investments don't typically spread through closed social networks. They advertise. They have prospectuses. They're available to the public or to qualifying investors through documented processes. When an investment opportunity comes through social connection with strong encouragement from trusted people in your network, the social trust is being weaponized. Ask why this opportunity requires exclusivity. Ask why it's not available through normal channels. The answers to those questions are revealing. Warning sign 6. Auditors and custodians you can't verify. Madoff used a tiny, obscure accounting firm with 3 employees, one of whom was an elderly retired accountant living in Florida, to audit a multi-billion-dollar investment firm. This was a massive red flag that almost nobody checked. Legitimate investment funds use major, reputable auditing firms. The fund's assets are held by large, verifiable custodians. If you can't independently verify the auditor or the custodian, that's a serious problem. Now let me give you the cleaner version of all of this. The core pattern of every Ponzi scheme is identical regardless of the size, the claimed strategy, or the sophistication of the operator. Someone promises returns that are better than alternatives. They use early investor money to demonstrate those returns. Social proof builds. New investors arrive. The scheme grows. Eventually, new money can't keep up with obligations. It collapses. Every Ponzi scheme in history has followed this pattern. Charles Ponzi in 1920, Bernie Madoff for 50 years, Alan Stanford, who stole $7 billion from investors in certificates of deposit. The crypto schemes that emerged in the 2010s and 2020s following the exact same playbook with new technology as the facade. The technology changes. The social network changes. The claimed strategy changes. The core mechanics never change. Understanding this pattern is the best protection. Because when you recognize the pattern in a new scheme, the specific details become irrelevant. It doesn't matter if the strategy sounds sophisticated, or if the promoter seems legitimate, or if everyone in your network is invested. If it pays consistent returns that defy market conditions, if the strategy is unverifiable, if there's social pressure to stay invested, if withdrawal is difficult, those are the warning signs. Always, without exception. The best investment in your financial life is the knowledge that lets you recognize what something is before you give anyone your money. Thanks for watching.